Okay, great. This is Lloyd Princeton with Design Management Company. It is my pleasure to host today's call on raising money for businesses, something that I consider a timely topic. It has been, but I think you'd have to be living under a rock to not have read the headlines as of recent about mega IPOs going doubling and tripling, well, at least doubling what they were intended to start out in, and as a result of it, we've had a number of IPOs that were going to be holiday stocking stuffers decide to postpone until next year, and maybe that's something that we can even touch on a little bit, but I want to welcome our speaker today, John Cohn with Diamond Capital Advisors, and I think we're lucky to have John, especially because year-end deal flow and all this good stuff. Plus, he's just a nice guy, but maybe that just hides the ruthless M&A and investment banking shark, inside of him. But John, I know you have an interesting background because in addition to being on the entrepreneur side with your own family company, which I believe you did, which you sold. I know you have a little investment banking background, and you've been involved with a startup fund as well. Regional in this case for Hudson Valley, and Brown University, Business School, Columbia. A few of the bits and pieces probably makes you qualified to opine on this. So, John, is there anything in your DNA that I didn't touch on that you'd like to mention before I start us with the topic?
Absolutely nothing that I want to mention, but you nailed it anyway. Thank you.
Good. Well, you also were a director at what is now one of my I think one of the institutions I really respect is Capital One. I don't know, for a variety of reasons, just from their morphing from credit cards into banking, or maybe it could have been the other way around. But I appreciate and respect the brand. So
they acquired a bank that I was a director of. So I had a very short life with them.
Very, very good. So, John, we have a number of people who are on the call and will continue to join the call, and as you know, this is being recorded. So, what my hope is today is that we can essentially touch on a few of the highlights of perhaps what the finance, and I use finance in a big bold word because I know there's many facets of it, from the investment banking side, from just the lending side, maybe with regular, normal institutions, names of which we would recognize, SBA-backed loans, there's crowdfunding, there's, the venture capital people, the private equity firms. There's a whole smorgasbord of stuff. And I know that within the architecture, design, and home furnishings industry, a lot of us have probably watched over the last 2 years in particular a number of people, more so with online ventures, anything that helps, economize the way people are selling home goods and furnishings. They've done their, in multiple series of fundraisers, and usually it's with, $1 million mark, with it, many millions, and people go, ooh, that looks good, that looks easy, and maybe I should do that too. So I'm hoping you can start us out and maybe take, 5 minutes to just touch on some of the highlights and what typically is looked for in a deal flow, why somebody would want to invest in anyone's, business, startup, and or, one that maybe already be several years under its belt, and maybe even profitable. Although I know if it's profitable, then it probably isn't going to get any money.
Well, that's only partially true, but yeah, I mean, there are as many reasons why somebody might invest as there are people. I happen to be in the Hudson Valley Startup Fund as a founding member. There are 72 partners, and we are also affiliated with, another 25 or 30 regional angel funds, and there's no way I could summarize, the massive variety of reasons why people are willing to invest. Most of the time, the simplest thing is they think they're going to make a profit. But realistically, we have now 10 investments. We've had one exit. I would say we've looked, and I personally have looked at maybe 200, 250 companies to get those 10 investments, which is probably less than the big venture capital firms would be looking at. But, principally, people are looking for a return. The Hudson Valley Startup Fund is a little bit of an exception because we're regionally focused, and part of our mission is a civic function to encourage entrepreneurship within the Hudson Valley, which is a very depressed area. But that's the exception. We still want to make money, but there are other reasons. So having said that, the differences between crowdfunding and angel investing and venture capital and then eventually private equity are significant, but the similarities are probably more than you would ordinarily think.
Do you want to take? Talk about that. Maybe take just a minute or two to talk about maybe just some of the highlights of the differences.
Well, crowdfunding is pretty new, and in the beginning, we had a broker dealer who basically their responsibility is to manage the SEC and the regulatory agencies for independent investment banks. And they wouldn't allow us to invest in or to work with anybody who had been gone through a crowdfunding process because they thought that some person that bought one share for $1 or whatever would be suing them. And fortunately, that turned out to be an absolute non-factor. In fact, the people that we use now will look at it the other way. And if somebody's gone through crowdfunding and attracted, hypothetical numbers, $1 from 1,000 different people, that's looked at as a positive. It looks at it like it's validation of the concept. So most of the people that we get to see as angel investors, which is the next stage up, have either gone through friends and family, their own personal funds, or crowdfunding, and their concept has been validated up to an extent. But they're also, they're not profitable. They may not even have revenue. And it's tough to value a company like that. But there's so many angel funds, and there's so many different ways of looking at it. The biggest thing is probably what they're looking at has to be compatible with what they're interested in.
Now, let me stop you right there, just because I don't want to assume people know exactly what we're talking about, and if I'm wrong, you'll tell me right away. Don't worry about embarrassing me in front of my peers. Crowdfunding, it's X number of people, friends, family, strangers who are chipping in a certain dollar amount, and generally people are enticed at different levels with maybe little giveaways or returns, but it's money that these people do not get back, and they also do not own part of the company. So that's crowdfunding. Somebody's actually given you the money, and you're able to utilize it however you want, and you still get to retain 100% ownership of your company. Am I correct?
Quite often you'll get an early version of the product or service.
Right, 100%. But that's all you may get in return. In fact, I just did a little donation for somebody who came up with a new hand cleaning mitt kind of thing. So, but in this case, I'm supposed to be getting an order of those, and I'll send you one, John, in appreciation for today's time.
Thank you.
You're very welcome. That being said, and by the way, that happens to be environmentally friendly, and it's made from recycled, plastics from the ocean. So kind of an interesting concept, but I think that underscores what you're talking about for different funds having whatever their purpose may be, and if it was something environmental, this particular product could fall under it. Now, when you mentioned the friends and family, and by the way, a book I just read, which I'll be talking about in a bit, adds a third F, friends, families, and fools, which I think that sounds a little negative, but doesn't surprise me from the author. Friends and family may be giving you or lending you the money, and I suppose you could even conjecture that they may even ask for equity too. So it is conceivable it could be any one of those three groups. Am I correct with that?
You are correct with that as well.
Okay, beautiful.
Most people want the big bang from a small investment, meaning they're looking for equity,
right?
Meaning they're looking for a big return on a small investment.
Sure.
And they're doing it, with some exceptions, obviously. They're doing it because they foresee a large return, whether it's 100 times or, and everybody's not trying to be the next Google or whatever. But, there's an awful lot between, a business that's raising $100,000 or $500,000 or $1 million versus what some of these high-tech venture capitalists are going to, look to invest, where they'll value a company, with no product and no sales and no nothing but an idea, and they could value a company at tens of millions of dollars or more and invest accordingly.
Or billions as we're ultimately seeing. Okay, and then let's move on to angel investing. If I'm not mistaken, angel investors are not just doing it from the good of their heart. They are actually taking a piece of equity, or they're lending the money, or it could be a combination of both?
Combination of both. Most angel investors that invest directly are investing only in things that they know about, or something that all of a sudden sparks their interest. But if I made my living as a farmer, I might be looking for agricultural technologies for my angel investments, or something specific in my existing vertical or my industry in general. And that also extends to family offices, which are a force, but they tend not to be early-stage investors. But the angel funds basically will start looking at pre-seed, which is, the idea, or seed, which is, okay, I've got an idea and this is how we're going to execute. And we may even have a product, hopefully a finished product, and a marketing plan, and if we're really, really lucky, they've got some revenue. They've sold it to a few people. So there's steps along the way, but there are hundreds and hundreds of angel funds around the country. Some are small, some are a little bit bigger. Some they all work in different ways. We pooled our funds up front, and we make investments on we're either all in or we're not in, so to speak. Of course, you're always free to invest your own money, but as a fund, we make one buy or one buy decision, and that's it. As opposed to going to an angel fund meeting, presenting to 20 people and having 3 people or 4 people, if you're lucky, ask about more information and eventually make investments. We make one.
Okay. Got it. And then I also just want to do a point of clarification for our listeners that, if you are not familiar with family offices are offices that exist to handle the financial needs of wealthy families. And in North America alone, the number is in excess of 1,000. And just to give you perspective, they frequently manage hundreds of millions of dollars, and that, it often is on the low end. There are often many, many billions representing many family members, and they too are always looking for some sort of deal flow, because at the end of the day, money sitting in cash earns you nothing, and if you've got hundreds of millions of dollars in cash, you're going to try to grow it by investing it. So you've got that. And then, John, can you take a moment to kind of round out our acronyms and such, the difference between the VC, PC, and the IB, and real quick?
The a VC, a venture capitalist, which is probably I could be guessing here, but my thought is that this is the bulk of early stage investments by far. I mean, if you took crowdfunding and angel funding and multiplied it by 10 or 20, you might begin to scratch the surface of what's available from venture capital firms. Okay, so what they do is basically once something comes across their desk that they like, they tend to make very onerous conditions to getting the money. You wind up somewhat vulnerable to their whims. And I'm not saying it's a good idea or a bad idea. It's just that it comes with a lot more risk than an angel fund who pretty much accepts that most of their investments are going nowhere, and hopefully they get one or two that work. And it's the same idea at the venture capital level, but because the numbers have been multiplied by such a great number, they tend to be more confrontational with management. They will force a lot of things that you might not ordinarily want to do.
Got it.
So
and what about
what
private
else
equity
did you want to
folks?
compare?
And private equity people and investment bankers, just so we get the terminology,
okay.
Know who the various players are.
Private equity is still a little bit separate. Private equity people, by and large, only invest in companies that have a minimum of $2 million in earnings, preferably 5, usually more than that, because like anything else, there are private equity funds that have $200 million to invest or $300 million to invest, not counting leverage. And there's some that won't invest less than $500 million because they can't manage 46,000 investments. They can only handle a dozen, 2 dozen, 3 dozen at a time at the most. So even the giants don't have massive portfolios of companies that they've invested in because they manage them. Now they'll usually take control, not always. And like anything else, there's some that'll invest small amounts of money for minority shares or bigger amounts of money for control. The thing that I like, Diamond, I should give myself a little plug here. Diamond Capital sells the companies that we represent overwhelmingly to private equity funds.
Is Warren
That's
Buffett,
the nature
is
of our
Berkshire
business.
Hathaway considered a private equity fund?
Pardon me?
Berkshire Hathaway, is that considered a private equity fund then?
No, Berkshire Hathaway. There is a company called Berkshire Partners, which is not Berkshire Hathaway, but Berkshire. It's more like an investment firm. They make a private. It's private capital, but it's public. But it's publicly held. Got it.
Okay. And let's just do a quick jump because I'm going to steer this in another direction. And then investment banker. What does your investment banker do?
The investment banker takes a company that wants to explore a sale. You've probably seen, in the newspaper occasionally, a company is looking for strategic alternatives. One of the things that we would do as an investment bank is lay out all the possible scenarios where it could be anywhere from staying exactly where you are to selling part of your business to selling it to your employees to selling all of your business, any combination thereof. And there are probably 13 or 14 that I'm aware of ways of selling or creating liquidity as opposed to liquidations. People get confused on that every once in a while.
I know,
it's obvious,
John. I know the distinction, and I go to bed at night praying that one day I will wake up and have a liquidity event.
Yeah. the heck out of a liquidation event. Anyway, yeah. So we would lay out all the possible scenarios that apply to any particular client and say, this is what you could expect if we do it this way. This is what you could expect if you do it that way. And then we assign percentages to the likelihood of being successful in pursuing any one of those alternatives.
Got it.
So it's a lot of work, and it's a very complex process. But on a simpler form, most of the time, the realistic and the simplistic thing is, some business owner gets an unsolicited offer from probably maybe a competitor, somebody he knows. I'd like to buy your business. I'll give you $2 million. And he has no idea whether that's a good investment, a good sale, a good price, or not. So he calls a lawyer or a financial advisor, sometimes an accountant, and says, what do I do? What do you think? If they're smart, they're going to tell us, I'll give you the names of 3 or 4 investment banks, let them analyze it, and come up with a plan. And that's basically how we get most of our business, through these trusted advisors. Because what we do,
Let me interrupt you there. I'm going to interrupt you there, John, but just for a minute. I'll tell you why. I think the people that we have on right now are probably not at that stage. If they're already at that stage, they may already be familiar with the nuances. I want to take 3 minutes to do a quick recap, and you tell me. You feel free to jump in and punch a hole if I've made a mistake in what I'm saying, and then I'd like to open it up for some questions, because I know people, I don't want anyone sitting glossy-eyed and scrolling through Instagram while we're giving them all these nuggets of phenomenal information. So as I understand it, there are essentially 3 primary tiers of what we're talking about from a business. We've got an idea, probably haven't created anything. It's just a concept and what we want to do. But I know I'm going to need money to take it further. So in that grouping, you can use your own money. You can get gifts or maybe borrow from family and friends, or potentially you can go to your bank or one of these primary sources, and depending upon your credit and your assets, you may be able to get a line of credit or borrow money to do whatever it is that you want to do. Possible also, if it's a genius idea, you may get a VC person, a venture capital fund that goes, we'll take you there. Or possibly you may get an angel investor who goes, you know what, you're trying to do the right thing. This is going to help, women and children, or it's going to save the environment. We'll toss you a little seed money as well. So that's kind of, as I see it, the first tier. We got an idea. Second tier is you already have your proof of concept. You've already made the product. You've already got it going. Hopefully, maybe you've already started selling it. You've got some buyers, or things are kind of lined up, or you signed your first contract with somebody and they're getting ready to do things. And now it's real, and you need to get an office, get a facility. You need to hire more engineers. You need to do something like that. And that's, opens you up potentially maybe even to some family office money. Probably all of the other things that I just mentioned as well. And now people get a little more interested because it's real and tangible. And once again, they may maybe lend you money, maybe invest in the company. If it's a VC firm, we've already discussed the fact that they're going to probably want to take control of the company as well, or at least have enough seats on your board of directors that they're going to be able to do things that you may or may not like. And then maybe the third stage is company's up and running. It's been going for a year or two. It could be more. It's profitable even, and maybe you're looking for an exit strategy. And at that point, as you pointed out, if you maybe had $2 million in revenue, or I don't know if we're talking EBITDA, you may be, speaking to an investment banker at this part that might say, hey, listen, you can sell the whole firm, you can sell part of your firm. Here's a few things, depending upon what you're trying to do. If you're just trying to raise money, here's one way. If you're trying to cash out, here's something else to do. So I kind of see it as those 3 tiers with roughly those potential players and points. What do you think?
That's roughly correct. There is another scenario, and I don't know if it applies to anybody that's on the line or not, where, for example, you have an existing business and it's going along, it's making money, everything's fine and dandy, but you've got a brilliant idea, and you're looking to expand it, but you don't have the capital available. What do you do then? And the cheapest thing is to go to a bank and borrow by far. The problem is personal guarantees. The most expensive thing you can do is raise equity, sell shares. But there's a bridge in between, and to those that can stomach it, it's very attractive because there are no personal guarantees. There's minimal interference. It's called mezzanine, and I won't go into it unless you think there's a need for it. But I see that as a scenario that happens once in a while too. We do raise money for companies like that, but it's got to be you've got to have a solid base, and if you have a solid base, they'll lend you 4 or 5 times what a bank would do based on your earnings. So that's that's very generous. The interest rate is higher, but even in that. It's usually paid at the end in a balloon.
Yeah.
It works. It's a great scenario. It's underutilized, but unless there's a specific need for it or the right circumstances, it's not for everybody.
Right, and I appreciate that. We'll park. Thank you for reminding it. We'll keep it out there in the ether, and I just wanted to, before I open this up to questions, I just want to point out, what I think something which is incredibly important, and that's just it, cost of funds. And that, whenever anybody wants to lend me money, I say, great, well, how much is it going to cost me? And they go, well, your monthly payment will be X. And I go, no. What's my cost of funds? What's this money going to cost me? Because right now, I can use my own home equity line of credit if I want to do something, and I think it's like 2.5% or 3%. It's really crazy cheap. So I know I can lend myself money for 3%. I also know that a number of people in our industry, for instance, may have retail shops or they take credit cards for their businesses. You can go to PayPal. There's a lot of businesses that will lend against what you're based on the amount of money that you charge that you accept in credit card payments on monthly. So, for instance, if you sell $20,000 a month in furniture, they'll consider, and if you have a pretty a good track record of it, and they'll generally look at the last 3 or 4 months of it, they'll say, okay, based on what we know you're pulling in, on a monthly basis, we're willing to lend you X amount of dollars, and it may be $50,000. Who knows? It could be 100. And the interest rate, because I've done that before, has been cheap sometimes, 3%, and sometimes they've come back to me and said we want 10%. There's no rhyme or reason to that. And small amounts of money you can borrow from like American Express, and then of course there's SBA loans. So it all boils down to cost of funds. And I even had a private party recently offer to write me a check for a couple $100,000 at 14%. That to me is hard money lending. Nonetheless, they're writing me the check. Nonetheless, I get to keep 100% of equity in my idea, and I'm not giving up any equity. So, those are the neighborhoods we're talking about. And then when John is saying, it gets expensive when you start going to VC, it's expensive because you've now given up a piece of your company, and a company today that may be worth, nothing. You don't think much of it, but all of a sudden your idea takes off, and now it's worth millions. Oops. You just may have
exactly.
It may have just cost you millions. So, with that being said, is there anybody that is online that has an idea or something that they were thinking they need money for, and they'd like to ask a question to John or myself?
Yeah, this is Joshua English out here in California.
Yes, sir.
Okay, yeah. So I have a patent-pending biocomposite material. It's made from hemp hurd, mycelium, which is mushroom roots, and cotton. And it's unlike other composite materials. It's completely backyard compostable, but it's just as strong as things like oriented strand board, or even kind of somewhere between wood composites and synthetic composites like carbon fiber. I've done a lot of this innovation in a very small shop. I'm an industrial designer. that also does furniture design as well. And my interest is in creating these one-for-one replacements for things like particle board, things that are super damaging to the environment. But I'm in this position where I know what the material can do, and I'm not trying to sell a product. I'm trying to, find people who want to license this material to make things with, mainly in furniture design. And so it's just hard to find those venture capital or any of these capital funds that will look at this type of thing that I'm doing, because it's really hard to categorize. And I've had people be initially interested and then lose interest when they realize, I don't even know where you stand with all of this. Where do you even categorize you?
I would look at angel investors in California, actually. There's what is it, the Angel Capital Association? They have directories. It's a lot of work. I mean, there may be 50 or 100 funds in California. Maybe there's a couple of them that would be interested strictly from the environmental point of view. And I can't speak to every venture, and every angel fund everywhere. But I know if that was in the Hudson Valley, we would look at it, and you would have access to the 70 investors that we have in the group to see who they would know and who they could recommend and who you could talk to. And it's a very, very collaborative group. In angel investors in general, they're happy to share. They're happy to help. You might run into a guy that's kind of creepy every once in a while and just wants to steal your idea. That could happen too. But as a rule, it's overwhelmingly collaborative, and a good place to start for something like this where you don't have a specific product. And we would help people in our region even if we weren't going to make an investment. That's part of our charter. So it's work. You got to find the right one or two, but it's possible. Because you need more. You need more than money. You need more than money. You need ideas, and you need their network.
Well, so I do have some concrete, tangible ideas, designs that I've designed that would use this material. Trying to pitch it to furniture design companies, and I have another really simple design that kind of showcases the product. It's one of the issues is I'm doing all the science. I'm cleaning the toilets. I'm paying the bills and doing all of that. And are there companies that help you locate those kinds of investors, like grant writers type of thing? Or is this just you want to get this capital, you got to do the legwork?
Yeah. There are people that claim to be able to help. One of the reasons I became an investment banker was I had my own company, a family business, which I bought out all the partners, and I was ready to expand it. And I was looking to raise a small amount of money, and I couldn't find anybody to help that was actually capable of delivering. I met a lot of people that said, if you pay me $50,000, I'll go look for the money. Well, who needs that?
Right.
I do not know of anybody that is reputable that can make a promise that they can deliver on that. It's highly unlikely, but anything is possible. But I don't know anybody.
I want to jump in, John. I just want to jump in too and kind of piggyback onto what you were saying. And for instance, Josh, and everybody, I'm going to share it with you when I'm kind of done with it, but I'll mention it to you now. A colleague of mine who I was hoping would be on today's call and was not able to join us, her name is Victoria Silchenko, quite a brilliant woman, and she just literally published, and it's on Amazon, a book called Raise and Rise, Funding Sources for Your Startup in the Era of Digital Transformation and Blockchain. And I'm only 150 pages into it, and so I got a couple hundred more to go. But the initial part of it basically she really hates VC firms, and the reason why she hates VC firms is because she says, they're really not there to help you grow your business. What they're really doing is, figuring out their exit strategy. That's really what they're looking for. They're looking for companies that they can jump into, make money, and exit. And then I highlighted this in the book for today's call, and she said that, in other words, successful companies with VC backing may well have been successful even without venture capital. Why? It is well documented fact that venture capital tends to follow up on discoveries, not discover them in the first place. Or quoting the Stanford scholars that she'd referenced earlier, VC-style financing is not the sole reason these companies succeeded. In fact, VC was not even the sole source of financing for many of these companies. So it's interesting, and I think, Josh, in your case, one of the words that I think is kind of important, which John said, is collaborative. You're needing somebody. It sounds like you're needing somebody to help you guide through this process and maybe even determine product and determine use and determine market so that you can narrow it down and then go after people who could be, who would enjoy your proof of concept and go, ooh, this is great. If you can make this, we'd buy it or we'd sell it. And, that isn't necessarily what you're getting from a VC firm. Now, interestingly enough, Victoria Solchenko is one, and who's probably one of many people out there who will help you write a pitch deck and who can do all that stuff and may be able to guide you along. But as John has pointed out, they typically don't do that for free. And while it may not always be 50, it could easily be 10 or 25. So, people aren't necessarily, doing that for free. So I think what it boils down to also, it sounds to me, Joshua, that you may, needing advice could also be different than needing money. Because if you don't know what you're going to do, then you really don't know how much you're going to ultimately need. And, that clarity is part of the factor.
Yeah, I have some proofs of concept. It really boils down to I'm really looking for strategies for raising money. That's what I'm running up against. I need other engineers working on this. I need all of that. I have the pitch deck. I have everything ready to go. I'm just waiting for the people who, to know where to go. I'm just a guy working in a shop, though.
Right. No, well, listen, and isn't that the best? Before I do, I want to give people see if anyone else has questions. But let me just ask you a question, Joshua. Do you have how much money do you think you need?
I've looked at kind of on the lowest side, $100,000. On the higher side, $250,000 would get me really kind of to the spot where I could start to play with some bigger players that are already doing things in the space. Right.
Well, and I won't put you on the spot, but depending upon how good your credit is and whether or not you own a piece of real estate and some other stuff, I don't know, John. Let's give him one or two or three places he might look for $100,000. What do you think?
Well, I'll repeat. I think that's a perfect angel investment.
Okay. And please repeat the name of the organization in California.
Pardon me?
What's the name of the organization in California you referred us to?
I didn't. I referred to the Hudson Valley Startup Fund.
No, I thought you said there was a group out here in California.
It's nationwide. It's the Angel Capital Association.
Okay. Got it.
I'm not sure where they're based.
Give that a whirl, and then offline, Josh, I may think of something else or two, and I'm happy to drop you a note. Is anyone else who's on have a question?
John, Fernando Diaz.
Hi, Fernando.
My question is, I get probably 2, 3, 4 emails a day from different sources saying, because of your credit rating and your Dun & Bradstreet rating, we can make available to you $300,000, $400,000, $500,000 at a very low rate. What do you think of those companies?
It's tough to comment without knowing who they are and what their reputation is. I think Lloyd mentioned American Express. If you've got that kind of credit rating, you can go to a bank. a regular old bank.
And he says unsecured funding.
Worth looking into, but they're going to be a little more expensive.
Well,
what are they quoting for unsecured lending?
3.56%, and they're out of there. It's called Proposed Capital out of Miami.
I don't know them. It sounds too good to be true.
Thank you very much. So Fernando, I was gonna chime in if John didn't say it. If it sounds too good to be true, it probably is. Because let me suggest. And by the way, I'm going to share a little story with you. I'm old school. I love meeting people in person. And the firm I mentioned a firm that offered to write me a check to buy a bit. I will mention to buy a business, not start a business. And I'm looking at little dry cleaners. I'm just looking at random stuff just to get something to kind of diversify my interests. And they said, it would be 14%, which is not inexpensive, and I know that, but I wanted to know what my options were. So I went to New York. They're in New York. They're near my family. I said, over Thanksgiving, I said, let's get together. The guy blew me off, and he never responded. And then, I did a follow-up, and I still haven't heard anything, which leads me to believe that there may have been a degree of catfishing in that. And how this goes is, once they get you to fill out an application or give bank statements, they now have all your identity. They have your Social Security number, your birth date. They may have all these pertinent data, and instead of lending you money, they may actually start taking what you do have. So to John's point, if it sounds too good to be true, it very well may be. You can check to make sure if these companies really do exist, but bear in mind that fraud is rife out there, and I personally know your circumstances, Fernando. So, depending upon what you're trying to do, I think you could be better off if you're willing to borrow the money. Heck, I would go to the SBA or something like that, and just go to a traditional lending source, because you've got assets, and you may not want to pull your cash out of retirement-related things or sell real estate. Makes perfect sense, but that makes you an ideal candidate to borrow your own money. And, we might even conjecture that you could look for a business partner who could step up to the plate and bring some of their own capital with them as well. And that might be, and we didn't discuss that, but that could be something else to explore. And what we didn't even discuss is, I think the conversation has been, I'm doing this all by myself, but, sometimes it's lonely at the top, and maybe there's, certainly an argument for seeing if there's someone who is compatible, and maybe particularly if they're good at things that you're not good at, running business and doing things like that. I might suggest that somebody should have a business partner who themselves brings their own resources and is looking for an opportunity. So I don't know. Do you have anything you want to add to that, John, or anything different?
No, I think that's exactly right. We see that quite frequently. We like to see, almost every business today has some kind of technology component, and we like to see at least one of the partners or one of the executives have some background that either permits them to do it themselves or to deal with the people that are going to do it. But that's just as a specific example. But that we see all the time. In most cases, a partner that brings some expertise and some money to the table is a really good choice. Now, obviously the problem is you're splitting the equity, and equity is the most expensive form of capital. But that's 100% of zero is zero. That kind of thinking. So.
Very, very, very true. And honestly, I through my consulting practice over the last 25 years, I have consulted with a lot of family businesses and a lot of partnerships, and I have helped with partnership formations and partnership dissolutions. And I would say largely, I've seen these various partnerships, harmonious. I don't necessarily recommend. I would not recommend against it based on the based on what I've observed. And I've actually surprisingly seen a lot of good husband and wife teams as well, or partner teams that are romantically involved as well. Some, it just for whatever reason, it seemed to have work. And there's a lot of established family businesses in our industry that own design studios and retail stores and trade stores, and they're multi-generational. So there's something to be said for having extra sets of hands. Any other questions? Any different questions or clarification on something we've discussed? No? Okay. John, we are at that beautiful ending point. If anything, we're a minute over. Is there a final thought that you want to share, or anything that you thought of that you didn't mention?
I think we covered what can be covered in a half hour on the phone.
45 minutes. Are you kidding? The day's half over.
Wow. But I would repeat this: the cheapest form of capital is going to a bank and signing your name. The most expensive is equity, and everything else is in between. And a lot of these things are hybrid, where you have convertible notes and it's really once you've seen it laid out, it makes sense. But until you've plotted out, it may seem overwhelming. But it really can be boiled down, and the other thing that's important is, what are you comfortable with? I don't like to borrow money. That's just me. I don't like to gamble either. But I think I like giving up equity less. So, and I'm probably not alone in that.
Well, no. I agree with you, and it's funny enough. My banker was just telling me that a lot of her clients are actually borrowing money because the rates are so cheap to put into the stock market, which to me is I do have a portfolio, but it's a form of gambling, and I'm like, oh no, the idea of borrowing money to put it into something like that could make me a lot of money or could lose me a lot of money. Sets off red lights. It's definitely not a comfort zone that I have right now, but. At any rate, I want to extend my special gratitude to you, John, because I actually did reach out to a number of different colleagues, and interestingly, they either said, oh, this isn't my space, I just don't know anything about home furnishings, and I said, it doesn't matter, it's a general call. Or they said, this is a good one too, they go, oh my God, it's highly regulated business, we're not allowed to have this conversation. I don't think, on behalf of FINRA and the SEC and everyone else, John, I don't think you have broken any laws today by generously sharing your time and your insights that you did. So I appreciate you. I wish you very, very happy holidays. I hope that your nor'easter doesn't disrupt your day and your week too much. And I also want to wish everybody else very happy holidays, and thank you to Josh and Fernando for your questions. This session is recorded. I'm going to go ahead and end the recording now, and the recording will be made available on my website. So happy holidays to everybody, and thanks again, John. Have a great day, everybody.
My pleasure, Lloyd. Thank you, and enjoy your holidays too.
Appreciate it.
Ho,
Cheers.
ho, ho.
Exactly. Ho, ho, ho. Bye, everybody.
Bye.